Friends, thank you for being here today. What if I told you that the trigger for the next Great Recession has already been pulled, not by a reckless bank on Wall Street, but by the world's most cautious government in Tokyo? And how long can the global financial system survive when its primary source of cheap liquidity, a mechanism that has underpinned asset prices from New York to London for decades, suddenly turns off the tap? These are not hypothetical questions for a distant future. They are the urgent reality of the present moment. Something dangerous has just shaken the global economy, and it did not start in the United States or Europe. It began in a market that most investors have ignored for a generation: Japan. For over 30 years, the global financial system has operated on a specific set of assumptions, the most critical being that Japan would always remain the silent stabilizer. We are witnessing the end of Japanese financial exceptionalism, a paradigm shift that threatens to shatter the tranquility of the global bond market and unleash a $12 trillion shockwave that no economy, including the United States, is prepared to handle. To understand the gravity of this moment, we must look beyond the headlines and into the mechanics of a meltdown that is unfolding in real time. Let's begin by examining the breaking of the silent stabilizer. Global markets are finally waking up to the reality that the world's most indebted advanced economy may no longer be able to defy financial gravity. For decades, Japan's government bond market was treated as a strange but harmless anomaly. The country carried a debt burden towering at roughly 230 to 260% of its GDP, the highest in the developed world. In any normal economy, such leverage would have triggered a sovereign debt crisis years ago. Yet Japan existed outside the usual rules of economics. It was the widowmaker trade for short sellers because, no matter how bad the fundamentals looked, the Bank of Japan, BOJ, always managed to keep interest rates near zero or even negative, effectively anesthetizing the market. This artificial stability created a false sense of security. The world came to view Japanese government bonds, JGBs, as a risk-free asset class that would never fluctuate. However, that illusion is fading, and it is fading fast. We are witnessing a violent repricing of risk. Japanese bond yields, which had barely budged for decades, have spiked to levels not seen in over a decade, with the 10-year government bond yield surging toward benchmarks reminiscent of 2007 or even 1997. Crucially, this sell-off is not being driven solely by foreign speculators or bond vigilantes from overseas. The call is coming from inside the house. Domestic Japanese institutions, banks, insurers and pension funds, who have loyally supported their government's debt for generations, are stepping back. They are losing confidence in the state's fiscal discipline. When the domestic entities that hold the majority of your debt stop buying, the game changes instantly. Japan has transitioned from being the world's reliable anchor of low volatility to a source of systemic risk, effectively pulling the pin on a $12 trillion debt grenade. But we must ask ourselves, why is the system cracking now? The answer lies in a specific set of domestic catalysts. The catalyst is a collision of political hubris, returning inflation, and inescapable demographics. The immediate trigger was a political gamble by the new administration in Tokyo. Just weeks into her tenure, Prime Minister Sanae Takaichi stunned investors by rolling out one of the most baffling fiscal expansions in recent memory. At a time when the economy required structural reform and fiscal prudence, the administration introduced a massive stimulus package valued at roughly $135 billion. This package was stuffed with what critics call political giveaways: rice vouchers, fossil fuel subsidies, and cash splashes. To the bond market, these measures did not look like investments designed to boost productivity. They looked like inflationary fuel poured onto a smouldering fire. The government effectively abandoned its target for a primary budget surplus, signalling a complete loss of fiscal discipline. This loss of discipline could not have come at a worse time, because inflation has finally returned to Japan. After decades of fighting deflation, the equilibrium has broken. Sticky, persistent inflation is forcing the Bank of Japan to normalize interest rates, ending the era of zero interest rate policy, ZIRP, that made Japan's massive debt pile serviceable. Inflation is the kryptonite to Japan's debt model. When you owe quadrillions of yen, you cannot afford to pay real interest rates. Furthermore, these policy errors are exacerbating deep-seated structural weaknesses. Japan is facing a demographic collapse unlike any other major power. Its population is shrinking, meaning there are fewer workers to pay taxes and, crucially, fewer savers to buy government bonds. The pool of domestic capital that has historically absorbed the government's debt issuance is drying up. Simultaneously, the banking sector is flashing red warning signs. Regional banks and even the central bank itself are sitting on massive unrealized losses on their bond portfolios. As yields rise, the value of the older, low-interest bonds they hold plummets. This creates a solvency risk that limits the financial system's ability to absorb new shocks. To understand why this situation is truly irretrievable, we need to examine the mechanics of the meltdown, specifically what economists call the impossible trilemma. Japan owes approximately 12 trillion US dollars equivalent. When you hold that much debt, you are incredibly sensitive to interest rate changes. Economists estimate that for every 1% increase in Japan's average borrowing costs, the annual debt service rises by roughly 3.6 trillion yen, about $36 billion. The projections are terrifying. The International Monetary Fund, IMF, and other analysts expect interest payments to double by 2030 and potentially quadruple by 2036. If rates normalize to even a modest 3% or 4%, interest payments alone could consume 1/3 of all tax revenue. No government can function when 1 out of every 3 tax dollars goes solely to servicing past debt, leaving nothing for infrastructure, defense, or the social security needs of an aging population. This forces the Bank of Japan into an impossible trilemma. A central bank in this position has 3 goals, but it can mathematically only achieve 2 at the expense of the third. First, they can try to defend the bond market by printing infinite amounts of yen to buy bonds, which devalues the currency. Second, they can try to defend the currency by raising rates, which crashes the bond market and bankrupts the government. Third, they want to support economic growth, which requires stability and low rates. Currently, Japan is cornered. The administration's spending blitz forced the bond market's hand, pushing yields up. If the BOJ intervenes to save the bond market, they sacrifice the yen. If they try to save the yen, they bankrupt the government. The volatility we are seeing, where the yen behaves like an emerging market currency and bonds sell off simultaneously, is the market realizing that the BOJ has lost control. The widowmaker trade is finally paying off because the mathematics of the debt have become impossible to ignore. I want to pause here and ask you a question. Given this impossible choice between saving the currency or saving the bond market, what do you think is the most likely outcome? Do you believe a collapse is inevitable, or can they engineer a way out? I'd love to read your perspective in the comments below. However, if this was solely a Japanese tragedy, the world might be able to look away. Instead, we are facing global contagion through the unwinding of the yen carry trade. Finance is global, and Japan is the beating heart of global liquidity through this mechanism. For decades, the carry trade has been the most reliable strategy for global investors. The premise is simple. An investor borrows money in Japan where interest rates are zero, effectively getting free money. They then take that capital and invest it in higher-yielding assets around the world: US Treasuries, American tech stocks, Bitcoin, or high-yield emerging market debt. Japan effectively acted as the world's ATM, dispensing cheap credit that inflated asset bubbles everywhere. Estimates of the total value tied to this trade vary, but some suggest it involves between $4 trillion and over $12 trillion in leveraged positions globally. Now look at what happens when Japanese rates rise and the yen strengthens. The math of the carry trade says breaks. If you borrowed in yen, a stronger yen means you now owe more money in dollar terms. If Japanese interest rates rise, your cost of borrowing skyrockets. Investors are suddenly forced to unwind these trades. This means they must sell their foreign assets to convert the cash back into yen to pay off their loans. This creates a vicious feedback loop. As investors sell foreign assets, global markets drop. As they buy back yen to close their loans, the yen strengthens further, putting even more pressure on remaining carry trade positions, forcing more selling. We saw a preview of this in August 2024 when a small rate hike by the BOJ triggered a massive flash crash. That was just a tremor. The earthquake is still to come. This liquidity shock creates a $12 trillion vacuum, and the most dangerous impact lands directly on the United States. We must remember that Japan is not just an ally. They are the largest foreign holder of US government debt, holding over $1.2 trillion in US Treasuries. For years, Japanese pension funds and insurers bought US debt because it offered a yield, whereas their domestic bonds offered nothing. But now, with Japanese yields hitting multi-year highs, the incentive structure has flipped. Why would a Japanese insurer take on the currency risk of buying US debt when they can now get a decent, safe return at home in Tokyo? We are seeing the beginning of a great repatriation. Japanese institutions are cutting their purchases of foreign bonds and actively selling them to bring capital back to domestic markets. This is happening at the absolute worst possible moment for the United States. The US government is currently running record deficits and needs to issue massive amounts of new debt to fund its operations. In a normal market, supply meets demand. But the US is facing a scenario where supply is exploding while its biggest customer is walking away. When demand for US Treasuries falls, the US government must offer higher interest rates to attract other buyers. This is why a crisis in Tokyo leads to higher mortgage rates in Texas. As Japanese demand evaporates, US Treasury yields must rise. Higher yields on the 10-year Treasury note act as the reference point for almost all borrowing costs in the American economy. Furthermore, if Japan is forced to defend the yen aggressively, they will do so by selling their foreign exchange reserves, which consist primarily of US Treasuries. This creates a doom loop that destabilizes the financial architecture of both nations. All of these factors combined are pushing us toward endgame scenarios that will define a new financial reality. Japan is the canary in the coal mine for the Western world. It has arrived at the destination that the United States and Europe are still traveling toward, a point where debt saturation meets rising interest rates, creating a mathematical dead end. The global financial system is interconnected, fragile, and leveraged. It was built on the foundation of cheap debt, and Japan was the final pillar holding that foundation up. That pillar is now cracking. The $12 trillion shockwave has begun, and as liquidity recedes and yields rise, the margin for error for governments, corporations, and individual investors is disappearing. The warning has been triggered. The only question that remains is whether the world is prepared for the volatility of the new reality that follows.